We are now going to get down to the basics of recording depreciation, not only recording it on our balance sheet and the formal presentation, but also the three methods in which we will learn how to calculate depreciation expense. So as we know, depreciation expense is recorded at the end of an accounting period with an adjusting journal entry. You all have been doing that now since Chapter 4. That is a debit to depreciation expense and a credit to accumulated depreciation. I'm sorry, it's hidden by the error a little bit there. Remember that depreciation accumulates in the contra asset account called accumulated depreciation. The presentation of that is the balance of the fixed asset account less accumulated depreciation gives us what we call net book value, or NBV is sometimes the way that we refer to net book value. What that is the fixed asset in a classified balance sheet less the accumulated depreciation equals the net book value of the asset. As you can see here, this is a presentation of that on the Wendy's Arby's group. You can see here where it says property net. That will tell you that accumulated depreciation has been netted out here to arrive at the $4,732,000. Fixed assets are reported on the balance sheet just below current assets, and the word net indicates net book value. Here again in McDonald's, you'll see a different presentation where it says property and equipment at cost, less accumulated depreciation, which they're showing you here, leaves us with net property and equipment, also referred to as net book value. So what you're seeing here is a couple different presentations, but they're saying all of the same thing. So now we want to turn to page 207. We're going to work an exercise. Page 207, number 2. And it says reporting fixed assets. At the end of the year, the Puppy Emporium had property and equipment with a historical cost of $100,000. Collectively, these assets had been depreciated $25,000, so accumulated depreciation was $25,000. Show two ways in which the property and equipment could be reported on the Puppy Emporium's balance sheet. So one way is the way that I've set up here, which would be net fixed assets or net equipment for $75,000. The other way that it could be reported would just be fixed assets or equipment net $75,000. So that would be the number 2 way. Let's go ahead and move on to take a look at how we calculate the depreciation expense. So how we do that is we take a look at, or we determine what depreciation method we are going to use. We want to estimate the useful life of the asset. We'll determine if that asset has a salvage value, or often also referred to as a residual value, and then the cost of that asset. So all of these items go into calculating the depreciation expense for an asset. There are 3 depreciation methods. One is straight line, which is the first one we're going to cover. Units at activity, which is the second one we're going to cover. This is also called units of production. And the last one we'll cover is double declining balance. I'm going to put these in 3 separate modules. So the first module that we'll be looking at will be focusing just on straight line with an example after the end of our discussion. So the straight line method. The formula for straight line is cost minus residual or salvage value divided by the asset's useful life. So that is the formula. Cost minus residual value or salvage value. They're used interchangeably, and I will use them interchangeably, divided by the useful life of the asset. This gives us the annual depreciation for the asset. So it gives us 12 months worth of depreciation. All right. So if we were going to take a look at a problem, let's go ahead and do that on the next slide. Actually, so they're taking a look at this problem here. It says, assume that Dozers purchased a truck on 1/1/2012 for $65,000. The truck has a salvage value of $15,000, so that means that we're estimating that the end of 5 years, which is the life, or 100,000 miles, we said that the truck will be worth, we think, $15,000. We don't know. This is an estimate. Sometimes company uses salvage value, sometimes they do not. If they wouldn't use a salvage value, then it would be 0 in our calculation. So using straight line depreciation, Dozer would record $10,000 per year. $65,000, which is the cost, minus salvage value of 15 divided by the useful life equals $10,000. You would debit depreciation expense and credit accumulated depreciation. So at this point, we're going to go ahead and work another problem from using this example after we take a look at what the depreciation schedule, is what we call this, would look for the asset. So what you should notice is that each year we take $10,000. We will do that for 5 years. So the net book value of this asset, as you can see here, decreases $10,000 each year. And the accumulated depreciation goes up $10,000 each year as the book value goes down. Now let's go ahead and take a look at page 207 and number 3. Page 207, number 3. It says Garrett Deliveries purchases a truck, so the cost of the truck is $18,000. The truck has an estimated salvage value, which I will abbreviate as SV, of $4,000. And it is expected to be driven for 7 years. So it's telling us that the useful life of this asset is 7 years. And Garrett uses the straight line method, which is what we're demonstrating here. They're asking us to calculate the annual depreciation. So to do that, we would take $18,000, which is the cost of the asset, minus the salvage value. So in this case, $4,000. This is the cost of the asset, divided by the useful life, which in this case is 7. So if we take $18,000, right? If we take 18,000 minus 4,000 divided by 7, will give us $2,000 annual depreciation. Now, if we wanted to take only 6 months, then it would be 1,000. If we only wanted to take 3 months, then we would take 3 months of 2,000. This represents 1 full year of depreciation. In other words, 12 months of depreciation. So to do anything less, you would have to do the calculation and then reduce it accordingly. Now what I'd like to do is to take a moment as I change to a different slide, and we'll go ahead and look at units of activity, or better yet, we call it units of production. So I'll see you all back in a minute.